Good morning, Trinidad and Tobago, and welcome to the Bourse Report. Today, we're taking a look at what has happened, or rather what has not happened, in international and domestic bond markets. In the bond markets locally, activity has been somewhat subdued in the first quarter and leaving much to be desired by investors. Limited opportunities and a relatively low rates of returns available continue to present challenges for investors seeking stable rates of return and income in the TT dollar market. Let's take a look at some of the factors that have been prevailing. And of course, demand for fixed income assets or bonds has far outstripped the supply of bonds in the local TT dollar market. And this has been reflected in the Trinidad and Tobago government bond yield curve, which has really not moved much for the first 3 months of the year. In fact, since December 2016 of last year. Low inflationary pressures have really not put much pressure on interest rates to be moving upward, as well as persistent excess liquidity in the banks. So we spoke about the yield curve. Let's take a look at what exactly we're talking about. And in the yellow or the gold line, that's the December 2017 yield curve, which gives a reflection to investors of what they should be earning on average if they were to hold a government security or a government bond. So for example, an investor who would be purchasing a bond with just around 2 years to maturity would expect to receive an annual rate of return right now of just around 2.94% per annum. That's pretty much what the rate of return that would have been expected in December of 2017 of just around 2.93%, and pretty similar to what would have been expected in December 2016. To get more meaningful returns, you would have to invest as far out as buying a bond with 10 years to maturity to earn or generate a return of about 4.3% annually, and that's if you can in fact access those bonds, which has been quite a difficult prospect, not just for the individual investor, but also for the institutional investors such as pension funds, insurance funds, etc. Now, one of the pressures that has been keeping interest rates low has been excess liquidity, and this is commercial banks' average excess reserves. And as you can see, excess reserves have been quite healthy at in excess of $2 billion since January 2016. And the most recent figure was just around $3.7 billion. So a lot of cash slopping about out there and working to keep interest rates a little bit lower than the investors would like. Also, lower inflationary pressures have created no incentive for the central bank through its monetary policy tool, the repo rate, to increase or put upward pressure on interest rates. And as we can see in this gold line, inflation has trended down to its most recent figure of just around 0.9%. Whereas deposit rates, ordinary savings deposit rates, have been just around 0.2% on average, meaning that investors with cash in the bank, while not earning as bad a negative return in prior periods, still have a negative return of just around 0.7%. So what can the local investor do? Well, in light of the relatively scarce supply of TT dollar bonds, what you can do is look at other ways to invest your funds, including money market funds, whose rates have been trending upward recently, as well as repurchase agreements, term deposits, and if you can, in fact, find bonds, well, all the better. Turning quickly to international markets, and much of the same, where significant investor demand and appetite for fixed income has been constrained amidst relatively limited supply of bonds as well. However, in the case of international bond markets, and we're speaking about US bond markets in particular, interest rates have been increasing by the central bank authority or the US Federal Reserve. And this has been leading to a phenomenon known as the flattening of the US Treasury yield curve. Let's take a look at what we're talking about. In March of 2017, or just roughly a year ago, an investor buying US government bonds would earn just around 1.25% per annum on that investment. And at that point in time, investing in a 30-year government bond would earn just around 3% per annum. So a difference therefore around 1.75% for taking that term risk or investing further out. Fast forward to today, and for a two-year investment, you would earn just around 2.25% or 2.27% for a US government bond investment, whereas not much has changed on the long end or the 30-year end of the curve, with just around 2.97% per annum being earned. And that differential has now narrowed between investing in 2-year and 30-year investments to just around 0.7%. So much more incentive for investors to stay on the shorter end of the investment spectrum. And what about the extra return? Because most investors don't typically invest in government bonds per se, but they look at emerging market bonds as an example. And the extra return that has been demanded is actually, after several years of decreasing, is now starting to increase. So back in January of 2016, the extra return investors would have been able to get was about 3.75%. That hit a low in the January of this year, actually, of just around 1.5%, and is now starting to trend upward. It's currently at 1.85% on account of geopolitical risk. And some of the geopolitical risk we are talking about include sanctions on Russia, the trade wars with China, and NAFTA renegotiations, etc. So what can investors do when looking at international bond investments? Well, in light of rising and continuously rising interest rates in the US, investors may be incentivized to stay on the short end of the yield curve or stick to shorter term investments, as we saw previously, as well as consider floating rate bonds, whose coupon rates reset on a quarterly basis and might provide some immunization against rising interest rates. That's it for this week's report. For more information on bond investments and what you can do to better add value to your portfolio, give us a call at 226-8773. Email us at invest@boursefinancial.com or visit our website at bourseinvestment.com. Have yourselves a wonderful investing week. This has been the Bourse Report.